seminar between, this is a joint seminar between the University and Probability Victoria. And our speaker today, Dr. Miryana Grigorova. She is from Leeds. She did her PhD in France. After that, she moved a little bit in Europe, taking different research positions, University of Bielefeld and Humboldt University in Berlin, the Center of Excellence in Risk in Insurance and Insurance in Hanover. And now she is in Leeds. So she is very active in financial mathematics. I very often see some conferences where she participates and organizes, and we are very glad that she is given talk today to us. Miryana, you are very welcome.
Oh, thank you very much for this very kind introduction, and thanks to all the organizers. The organizers of both seminars for the invitation. I will be speaking about superhedging of options in a nonlinear incomplete financial market model. And as mentioned also in the abstract, I will focus on the superhedging pricing of American options, and as also mentioned in the title. And I would like to apologize beforehand to Professor Nino. I see that she's in the audience, and I believe she heard already most of this talk sometime before. So this is based on several joint works with Marie-Claire Kenez, who is at the University of Paris, and Agnès Sulem, who is at INRIA, also Paris. As was mentioned also in the introduction, so that is a talk which is in mathematical finance. But even if some of the participants are not so very familiar with financial mathematics modeling, they will still be able to follow, because I will introduce all the notions that I will need. And I will start by some very general motivation before making the talk mathematically more precise. So the model that I will be considering will have those three features which are mentioned here on this slide. So the market models that I will be considering will be incomplete, and that is understood in the usual sense which we have in financial mathematics. So in the sense that not every European contingent claim can be replicated by a self-financing portfolio. So of course, those who are familiar with mathematical finance, you know that European contingent claim we typically model by a random variable, by one random variable which is measurable with respect to the information available at the terminal time, and which has some integrability, typically has some integrability, satisfies some integrability property. And that is about incompleteness. So the other feature, another feature which the market models that we'll be considering will be this nonlinearity feature. And that is to be understood in the following sense. When we write, so we will consider only models in which, when we write the dynamics of the wealth process, right, my wealth coming from my portfolio, those dynamics will exhibit a nonlinear driver. So there will be a part in dt, there will be some stochastic integrals part, and in the part in dt, the driver which will appear will be typically nonlinear in the wealth itself, and also typically nonlinear in the strategy. And I wish to emphasize that it will be nonlinear. It can be convex, but it can also be non-convex. So typically we will be seeing operators, and we will be manipulating operators which are nonlinear, not necessarily convex. And so we will not be able to use tools from convex analysis for this precise reason. So that nonlinearity of the driver can include a number of market imperfections. Not all market imperfections are of this type, right? But a number of market imperfections are, and we will see some examples, and I have mentioned also some examples of such imperfections here. And the third feature that we'll take into account in the market model will be a possible jump, right, of the underlying risky asset at the time of default. So let us now see what are our goals. So it is about, so because our market model will be incomplete, so not all European options will be replicable, and so we will not be speaking about price of replication. We have to speak about something else, and so we will be interested in the super replicating price, in the superhedging price, and I will define that later on. So as I mentioned, we will focus on the American options case because this is somehow technically more involved than for instance, the European options case. And as you remember, in the American option, so we have two counterparties, a buyer and a seller of the option, and their role is typically non-symmetric, even in simpler market models than the ones that we will consider here. Why are the roles not symmetric? Well, so the buyer of the, so let me first mention that American option is typically modeled by an adapted stochastic process, which is typically assumed to be or to have trajectories which are right continuous with left limits. So for us, an American option will be just once more an adapted process which has a right continuous trajectories with left limits. And so the buyer of the option can exercise this option at any time between the current time and the maturity of the option. The exercise times being modeled by stopping times. And if the buyer chooses to exercise at some stopping time, let's say tau, the seller of the option has to give the payoff, let's say psi tau, to the buyer at this time. So we have treated in our works with Marie-Claire Guenez and Agnès Sulem, we have treated also the case where the given payoff of the American option has measurability, of course, but it's not necessarily right continuous with left limits. That is not so regular as that, but that is in the paper on which the talk is based. But I will not cover this case in the talk itself, so that not to overburden the talk with technical difficulties. Yeah, so we have considered, so I mentioned again in the paper, we have considered American option modeled by a stochastic process which is just optional, not necessarily right continuous with left limits, and which has some square integrability. Yeah. So what are the type of results that we'll be interested in? So as I mentioned in the case of American option, so the buyer and the seller are not symmetric, so we will have the point of view of the buyer and also the point of view of the seller. So we will be interested in the superhedging price for the buyer and the superhedging price for the seller. And we will wish to establish a connection between those superhedging prices and some more handy stochastic control problems, right? And that is, those are the duality results that I mentioned here. And so we will also see another type of results, which will be a characterization of the superhedging price in terms of a backward stochastic differential equation. So those who are familiar with backward stochastic differential equations literature, they will not be surprised that we see reflected BSD, reflected backward stochastic differential equation appear, because we are dealing with American options. And so the reflecting barrier will be the payoff process of the American option. And because we are in an incomplete market, we see constraints, sorry, I clicked something. So we will see a constraint on the control processes appearing in the BSD. So I wish to recall here that there are, let's say, there are two big approaches, right, to pricing or to superhedging pricing of options in the financial mathematics literature. One is the so-called Martingale approach, and the Martingale approach typically leads to results of this first type. And the other approach is the BSD approach, the approach by backward stochastic differential equations. Sorry, I again clicked not where I should. So the second approach, the approach by backward stochastic differential equations, it leads typically to results of this second type. And of course, I will have to explain here what the Martingale approach will look like in my case, where I deal with operators which are not nonlinear, not necessarily complex. Right? I will now, so that was a very general somehow introduction. And now I will give a concrete example of a market model. So capital T will be a fixed terminal horizon corresponding to the expiry date of the option. So we have an underlying probability space that is our, let's say, historical or physical probability measure. And this probability space is sufficiently rich to carry a one-dimensional Brownian motion W. So as I mentioned, I wish to model the possibility of the risky asset defaulting. And so I introduce this random variable, curly theta or theta beautiful if you want, which is just a non-negative random variable, which will model the time of default. So in fact, all that we see on this slide and on the following slide, there is nothing new here, and that comes from the literature on modeling of default. I see that there are some specialists on that in the audience. So I just mentioned that for the notation that I will be using. So N will be the so-called default process, default indicator process, so which is equal to 0 before the time of default, which jumps at 1 at the time of default and stays at 1 after that. And my filtration, of course, that is very important, will be the filtration generated by the Brownian motion W and the default indicator process N, right? And all the measurability, which I will be mentioning later on, will be with respect to this filtration G, right? Predictability will be with respect to that. Optionality will be with respect to that. The notion of a stopping time will be also with respect to that filtration, right? And my processes, so for instance, the risky asset process will be driven, right, by the Brownian motion W, and also by the so-called compensated martingale, which is the default indicator process N minus its predictable compensator. And here I make an assumption which is often made in this literature. I make the assumption that the predictable compensator of N, right, this predictable compensator is of this form, right? It is absolutely continuous. So that is my assumption, that it is absolutely continuous with respect to the Lebesgue measure. And that is the density process, which is typically called the intensity of default, right, this small lambda process here, right? And I will assume that the default can appear after any fixed time small t with positive probability. And I will make this assumption, which is also often made in this literature. I will assume that W, which is of course a Brownian motion in its own filtration, remains a Brownian motion in the bigger filtration G, right, which was generated by W and by the default process N. And I will also assume, to simplify, that the intensity process is bounded. So now that is about somehow the underlying probability space and my filtration, right? And now I will model the assets which are available in this financial market, and I will always have only one risky asset, right? Which is modeled by this stochastic differential equation, right? Forward stochastic differential equation with S0 being the initial condition, right? And so I will have just one risky asset and at least one riskless asset, but possibly more than one riskless asset. And what do I call a riskless asset here? It will be an asset in the dynamics of which I have just a dt part, but not any stochastic integral part, right? If I have a stochastic integral part, I call it risky. If there is no stochastic integral part, I call it riskless. So those processes here, the drift process mu t, the volatility process sigma t, the volatility process, right, they're assumed to be predictable and bounded processes, and be strictly greater than -1. So already here somehow, before even defining the wealth process, right, I can see that this market model, a market model like that, with underlying assets which are like that, is incomplete. And roughly speaking, this is because I have two sources of risk, right? The Brownian motion and also the default Martingale M, right? And only one, right, risky asset available for trading. So two sources of risk, but only one risky asset available for hedging, right? And so that will, intuitively speaking, that will lead to the incompleteness of the market. Now, let me explain how portfolios or wealth processes are built here. So we start with an initial wealth, let's say small x, and so we choose the amount of money phi t, invested in the risky asset at time t, right? So phi t is the amount of money, not the quantity of risky asset, but just the amount of money, let's say in pounds or in dollars. Yep. And so here H2, of course, there are different objects that, which are denoted sometimes by this same symbol. So here H2 for me are just the processes which are predictable and which are square integrable with respect to the product measure dt cross dp. So maybe I can show you here. Also, let me try to do one operation to see if it works. So it is, right, it is, hopefully you see that. So that is H2 here, right, this space. Okay, so and the wealth process, it starts from X, it follows the strategy phi, and we will consider models where the wealth process, when I write the self-financing condition for the wealth process, right, I obtain dynamics of this type, right? This is again a forward stochastic differential equation starting from the initial capital, small x, right? I will give you examples of drivers later on in the talk, right, which fall in this class, right? And the driver F is typically nonlinear in VT, in the wealth, and nonlinear in the strategy, phi t, and possibly non-convex. It can be convex, but it can also be non-convex. But it is Lipschitz, right? I wish it to be Lipschitz so that to fall in somehow in the classical case, in the classical BSD theory. Yeah, the BSD theory with classical, let's say, assumption. So let me formalize a little bit more the remark which I made just before about the incompleteness of the market. So of course, when I speak about market incompleteness or completeness, what is very important is the class of terminal payoffs that I consider, right? The space for the terminal payoffs that I consider, right? So, and here, this is the terminal payoffs which are measurable with respect to the information available at t, and which are square integrable. And if we look closer, we see that if I take an arbitrary terminal payoff eta like that, I might not be able to find an initial capital X and a trading strategy phi, such that at the terminal time, the value of my portfolio is exactly equal to eta, almost surely, right? So indeed, how do I, so that is the replicating problem for the European option with payoff eta, and I can write this replicating problem for the European option with payoff eta in BSD terms, in terms of backward stochastic differential equation. So I want to find, right, V, wealth process V, and trading strategy, let's say Z, which is related to phi by this very usual change of variables, right? I want to find again, so a wealth process VT and trading strategy Z, such that this equation is satisfied, where here I want at the terminal time my wealth to be equal to my given terminal payoff eta. And so, but I notice that this, so that is the here the replicating problem in BSD terms. But when I look at this BSD, I notice that it might not have a solution. So I might not be able to find such a pair VZ. And why is that? So for those who are familiar with the BSD literature, they already guess somehow the answer. It is because here I have the same, I mean, not that I have put it, it is the same Z which appears in front of the Brownian motion W, and the same Z which appears in front of the Martingale M. And from the theory of BSDs, I know that if I want such type of BSD to have a solution, I have to put here one control process. I have to be able to put here one control process, let us say Z, and a different control process in front of the jump Martingale M, let us say a control process K. But here I do not have this case, right? And so this BSD, for some etas, square integrable etas, this BSD might not have a solution. Right, all right, and so I see from this point of view, the BSD point of view, that the market model is incomplete. Such market model is incomplete. Okay, let me give you some concrete examples of models which fall into this framework. So the first one is a relatively simple example. So it is, I have called it a Black-Scholes type market model, right? But of course, the difference with the usual Black-Scholes is that here I allow the underlying asset to default. Like I allow this feature. Right, so the risk-free asset is of this form, right? The usual form in Black-Scholes. Well, the very classical Black-Scholes is with the interest rate R being equal to a constant, mu being equal to a constant, and sigma being equal to a constant. But you're right, this is a slight extension with R, mu, and sigma predictable and bounded. But the main difference with the Black-Scholes is here, right, in this part, in the possibility of jump at the default time of R theta. So the risk-free asset is of this form, the risky asset is of this form, as before. And so in such a market model with those two assets, right, if I write the self-financing condition, so let me recall the self-financing condition, we always, we almost always use self-financing portfolios in pricing. So roughly speaking, I want that the infinitesimal variation of my portfolio be only due to infinitesimal variation of the underlying assets, that is to the infinitesimal variation dBT of the risk-free asset and the infinitesimal variation of the risky asset. So we say sometimes things like that to our students so that they somehow memorize the self-financing condition, right? And so if I write that here, right, and I replace dBT and DST by the dynamics and I group the terms, I obtain a dynamics, right, of this form. And here is the driver which pops up, right? So that, of course, let me just emphasize, so this is exogenous modeling. This is exogenous modeling, but now this is a result of my computation, right? And so the driver which pops up, what pops up here is this driver. It is the same type of driver as in the classical BS model. And so that is something which is linear, obviously, in V and linear in phi t. So this will be, this example will be my benchmark somehow model for the sequel. So the BS model, the Black-Scholes model with default, will be my benchmark my benchmark model for the sequel, and I will call that the linear incomplete case. Right, linear because the driver which appears here is linear, and incomplete because that is an incomplete market model, as we saw. Okay, let me give you one example of a nonlinear incomplete market model. So again, I have the same risky asset as before, but now I have two risk-free assets, let's say B1, B2, with a different interest rate in B1 and in B2, where typically I assume that small rt is less than or equal to the capital RT. And so the small rt will model the interest rate for lending, and the capital RT will model the interest rate for borrowing, right? And so how do I somehow introduce in the modeling, so because now I said small rt is the interest rate for lending and capital RT is the interest rate for borrowing, but how do I make that appear in the, so this sentence, how do I make it appear in the modeling? So I will introduce those two trading constraints. So I will say that the riskless asset B1, I can only buy it, right? The trader or the economic agent can only buy it. And the interest rate, sorry, the riskless asset B2, I can only sell it, right? And so if I write the self-financing condition in this case, right, and I group the terms, so I obtain these dynamics. And that is the driver which appears here. That is the driver which appears here. And obviously that is nonlinear in V and also nonlinear in phi. Right, so that is the example of Black-Scholes model with default and with possible different interest rates for borrowing and lending. Right? Yeah. So remember, phi t, that was the amount of money, right, invested in the risky asset. So that is something in dollars. So VT is also something, a wealth in dollars, right? VT minus phi t is something in dollars. If that is something which is positive, right, I place it at the interest rate for lending, small rt, and if it's something that is negative, minus this amount, I borrow at the interest rate for borrowing, capital R. Right? Okay, so so here I emphasize the driver from the linear case because, as I mentioned, that will be my benchmark case, and then here I put the driver in this nonlinear case for different borrowing and lending, just after rearranging the terms a little bit. So so that example is very well known. There are also other examples very well known, which include proportional taxes on the gains from investment in the risky asset, for instance. And I haven't written here the form of the driver because depending on the way you take into account the taxes, that leads to a different driver, right? There is, of course, the very vast literature on counterparty risk, and I see Marek Rutkowski in the audience. So that is just one example, but there are many other examples from this literature. And we can also take into account the effect of a large trader on the default intensity, right, which is not covered in this talk right here. Obviously, that's a small trader who is price taker, let's say, in more financial terms. Okay, and so just to summarize a little bit, so in my vocabulary here, right, I can have models which are linear complete. That is, for instance, the classical, the usual Black-Scholes model, right? I can have a model which is linear incomplete. That was my first example, the Black-Scholes model with the possibility of default. I can have a model which is non-linear complete, right? That would be, for instance, I didn't give you the example, but that would be, for instance, the classical BS model, for instance, with different borrowing and lending rates. So it will fall in this class. And I can have the more general models, which are non-linear and incomplete. And the example is my second example, right? The BS model with possibility of default and with different interest rates for borrowing and lending. And of course, it's presented like that here, but of course, this first is included somehow as a subset of the second one. And here again, this first is a subset of the second one. And also somehow the linear complete market model, which you can see it as a subset of the linear incomplete, and similarly for this one. Yeah. Okay, so let us come now to the, after those examples, to the a problem that I faced, so to my object of study. So my object of study is first, from the point of view of the seller, the superhedging price of the American option. So as mentioned before, so an American option will be modeled just by a stochastic process, which is adapted, right continuous with left limits, and which has some square integrability. And I can tell you exactly what this square integrability is. So let me just see how I'm faring with time. So this S2 space is the space of processes, let's say phi, just some generic notation for a process, which are adapted, right continuous with left limits, and such that the expectation of the supremum of psi s square, right, is finite. So that's a usual notation in BSD, and this one is also usual for BSD, right? In some other fields of stochastic processes, it might denote something else, but in BSD, that's typical. Okay, and so what is the, so I denote by this curly T, the set of all stopping times in this model. Until U0, I want to study U0, the superhedging price of the American option from the point of view of the seller, that is the minimal initial capital that the seller, that allows the seller to find strategy phi such that the corresponding self-financing portfolio is enough for the seller to pay to the buyer the payoff, whatever the exercise time tau chosen by the buyer. So somehow the seller can cover it's the minimal initial capital, allowing the seller to cover the liability, whatever the exercise price, whatever the exercise time, sorry, chosen by the buyer. So now we mentioned, so seller and buyer are not symmetric somehow by definition of the American option. So I will also consider the point of view of the buyer and the buyer superhedging price, which is typically defined in this manner. So I denote it by U tilde 0. And that is, how do I read this now? So that is the maximal amount of that the buyer can borrow, somehow in inverted, borrow in inverted commas, through the underlying assets, right? The underlying assets in the market, such that they can find a trading strategy phi and also a stopping time, right? An exercise time tau, such that if they follow the trading strategy phi and if they stop, if they exercise the option at the stopping time tau, then the amount from the American option, the payoff from the American option that they will receive from the seller at this time tau is enough for them to repay their debt, right, contracted in the underlying assets, right, through the portfolio in the underlying assets. So those are very well-known definitions. So I don't know the first time when the seller superhedging price appear, but for the buyer superhedging price, I believe that at least in the financial mathematics literature, that is from the papers of Karatzas and co. A long time ago, right? Not in the framework of the market models that I display here, but still that is the definition, right? And so now I want to give a dual characterization of those prices. That is, I want to establish what is typically called in this literature a pricing hedging duality. That is, I want to relate those two objects, right, to some more handy stochastic control problem. Because of course those definitions are financially meaningful, but from a mathematical point of view, it's very difficult to manipulate, right, and to work with. Okay, and I will focus on the seller, on the seller's point of view. Okay, so first of all, I would like to display the duality result in my benchmark model, in my benchmark case, which was the linear incomplete case. That is the Black-Scholes case with default on the risky asset. And so what happens, for simplicity, I will assume RT to be equal to 0. Otherwise, this formula is true up to discounting, right? And I want to display the duality formula in this case. How does it look? For those who are familiar with this literature, it's not surprising. So the superhedging price of the seller is equal to the supremum overall Martingale probability measures of the supremum overall possible exercise times of the expectation under the Martingale probability measure R of the payoff, right? So how can I, so curly R here, I denote by curly R the set of all Martingale probability measures. How are those defined? Those are the probability measures which are equivalent to the initial probability measure P, and under which the wealth processes become martingales. All the self-financing wealth processes, no matter what is the initial condition and no matter what is the trading strategy, they become martingales, right? So how do I typically read this such type of result financially? So my initial market model, remember, even in this linear case, it was incomplete because of the presence, somehow, roughly speaking, because of the presence of the default. So it is incomplete. So what I'm going to do, I will build auxiliary market models, right? Each of which will be a complete market model. So the set of those auxiliary market models has to be carefully chosen. So it has to be a suitable set of auxiliary market models. And what are the auxiliary market models? They're indexed by Martingale probability measures, right? So there are as many auxiliary market models as there are Martingale probability measures. And so I will consider in each of the auxiliary market models, which I have artificially made to be complete, I will consider the price of the option that is of interest to me. So in market model number, auxiliary market model number R, the price of the, so right, in auxiliary market model number R, the price of the American option is given by that, by the supremum overall stopping times of the expectation of the payoff, right? And so then I take the supremum overall auxiliary market model. All right, so what happens now from the point of view of the buyer in this, again, benchmark model, which is the linear incomplete market model? So the superhedging price of the buyer is now, I can show that it is equal to that. So now again, I have the same set of auxiliary market models, as many as there are Martingale probability measures. And in each of them, right, I take the price, right, the superhedging price of the American option in auxiliary market model R. Of course, that is the same, right? In the linear case, it's obvious that what I have here, of course, that is the superhedging price of the American option in auxiliary market model R. It is the same as the superhedging price of this same option from the point of view of the seller. But of course, that is true only because I'm in the linear case. And at the moment when I pass to the non-linear case, of course, here the linear operator will be replaced by a non-linear operator, and I will no longer have this equality, right? So for the case of the buyer, I need an additional regularity assumption on the payoff of the American option. And why is that? Well, because in the case of the buyer, I want to be able to find not only a trading strategy, but also I want to be able to find a stopping time, an exercise time tau. And we know already, even from optimal stopping theory, right? Optimal stopping theory in the linear case, that in order for me, that is, even if you abstract yourself from the infimum here, right? And you just consider an optimal stopping problem of this type, right? You know that for you to be able to find an optimal stopping time, so you need an additional regularity assumption on the reward process. So now, if I want to pass from the linear to the non-linear case, right, I obtain a result which is of this form for the seller's superhedging price, that is the superhedging price from the point of view of the seller. So I have here, so what are the differences with the previous case? Well, as I mentioned, right here, the linear expectation is now replaced by a non-linear operator, right? A non-linear operator which depends on the driver, which depends on the time of evaluation, which is the time of pricing, which is here 0, which depends also on the time when the payoff falls, which is here tau, and which depends also on the auxiliary model in which I am, right? And I have an analogous formula for the duality in the case of the buyer, right? Again, under this additional regularity assumption on the payoff basis, right? Of course, we do not understand yet what is that. We see somehow the analogy with the linear case, but we do not know yet the details. And my purpose now is to present some of the details, right? And to give some elements of the proof of those results. So let me start here. I will wish to present this part as a parallel, right, with my benchmark case, which was the linear incomplete case, that is the BS model with possibility of default. So in the linear case, I saw in the duality formula the linear operator appearing, that is the usual expectation with respect to the Martingale probability measure R, or more generally, I will see appearing the linear conditional expectation, right? In place of that, in the nonlinear case, I see that nonlinear operator appearing. So how is it defined? So first of all, so somehow I start now in more economic terms, I start explaining now how I build exactly those auxiliary market models, right? So I start by taking just any probability measure Q, which is equivalent to P, just any. And then I know that in this framework, I have a predictable representation property that I know from earlier works, in particular by Monique Jean-Blanc and Chigisson. And so I know that the density process of Q with respect to P is necessarily of this form, right? Where alpha and mu are some predictable processes with nu, which is like that. Then I can apply Girsanov's theorem. I can pass from P to Q somehow. So, and I know by Girsanov's theorem, somehow that tells me what is the behavior, if you want, or how do I have to change W so that it becomes a Brownian motion under Q. So Girsanov tells me that this process WQ is, right, a Brownian motion under Q, and this process MQ is a martingale under Q. Remember, so nu is this mu here, and lambda was the intensity of default which I had from the very beginning. So now I have somehow the behavior of the risk of my risk source no longer under P, but under this equivalent probability measure Q. And now, how do I build my auxiliary model under Q? So I do the following. So let us compare here this equation with the equation that I had at the very beginning, right, when I wanted to price ether in my original market model. So what is the difference here? I put here the same driver that I have at the beginning, the driver which appears in my self-financing condition, whatever that driver is, right? And what I do here, now I have the source of risk under Q, the source of risk under Q, right? The two sources of risk under Q. So that is the first difference with my original model, which was under P. And the other also very important difference is that now I have artificially put here Z, right, as before, but here in front of the second source of risk, I have artificially put a different stochastic process called here K, right, which I couldn't do in my original model. right? So somehow in this auxiliary model number Q, I allow my agent to be able to hedge against the Brownian motion, right? Which I was able to do also in the original market model. But I also artificially allow my agent to be able to hedge against the second source of risk, which was the default martingale, right? By writing artificially here this possibility of hedge. Of course, that market model does not exist, right? It's just something that I artificially create. And then what do I do? So I notice that because I did that, right, from BSD point of view, because I allowed the agent to be able to hedge against both sources of risk, for BSD point of view, now I have a solution triplet, right? Because I allowed myself to look for a triplet, I have now a solution triplet. That's the BSD theory which tells me that. And let X, Z, and K be the unique solution triplet of this BSD on the Q. So because I have a unique solution triplet, in fact, I can define a pricing rule in this auxiliary market model Q, which I couldn't do in my original market model because there the BSD didn't even have a solution, right? How do I define my pricing rule in my auxiliary market model Q? I say the following thing. So I say, I take my given terminal payoff, which corresponds here up to here to a terminal payoff of a European option. And I say that I will consider the operator which associates to that given terminal payoff eta the position of this, the first component of the solution of this BSD at time t, right? So this operator, I call it curly E. So F, because it depends on the driver F here. So the F here is the driver of the pricing BSD in the auxiliary market model Q. So I have the dependence on Q because I'm on the Q, I'm in the auxiliary market model on the Q. So the Q which is here is the same as the Q here and the same as the Q here. Small t, because small t is the time of evaluation, that is the time at which I want to price in the auxiliary market model number Q, and capital T is the time when the payoff falls, right? So I have all that dependence, so it's a little bit a heavy notation, but it can't be avoided because really we have explicitly that dependence, right? So these BSDs, so from BSD point of view, whenever a BSD is well defined, that is, has a unique solution, it naturally induces an operator like that. And if the driver F is non-linear, so if the driver F is linear, this operator is linear. And if the driver F is non-linear, this operator is non-linear, right? Okay, now, what I'm going to do, so what I'm explaining here is now I connect that to the very well-known Shigepan's G expectation. So that is, as a matter of fact, Shigepan's G expectation is a particular case of that. Well, why they speak of G expectation because he denotes typically the driver F by G. So, and moreover, he typically makes additional assumption on the driver F, so that the operator that he gets is convex. As a matter of fact, is convex and does not depend explicitly on the time at which the payoff falls. That is just to make a connection for those which who are familiar with this notion, right? All right. So now what I need to do. So now I have this operator is well defined. So, or in more economic terms, this nonlinear pricing rule in auxiliary market model is well defined because the BSD has a unique solution. Now, I typically want this pricing operator to be non-decreasing, right, to be monotone. And so I will impose an additional assumption on the driver F so that to make this operator monotone. I do not display this assumption, but that is something typical which we do in the theory of BSD with jumps. When I don't have jumps at all, that is when I don't have this term, it is always true, if I'm in a Brownian setting, it is always true that this nonlinear operator is monotone. But when I have jumps, typically it is not true for any Lipschitz F, and I need an additional assumption on it. Okay, now once I have those nonlinear operators, I can define the notion of a martingale with respect to them, right? So how do I do? So that's the analogy with the definition of the martingale in the linear case, right? There I had a family of nonlinear operators. In the linear case, I had a family of linear operators, which were the linear conditional expectations. Now I have a family of nonlinear operators, which are those nonlinear evaluations here. And so I will define the notion of a martingale with respect to them. So I take some generic process, yt, and I say that it is a strong nonlinear martingale, a strong nonlinear FQ martingale, right? If it satisfies this property, right? Here, so sigma and tau are stopping times such that sigma is less than or equal to tau. So in the nonlinear case, somehow, so you see the analogy with the usual definition of martingale, right? So in the usual definition of martingale here, I have, so how to explain that? Let me start that again. So I have we have generalized here the the usual definition of a martingale from the linear case, and somehow we have put Dub's optional sampling theorem in the definition, right? In the linear case, that's somehow a result. Well, here I have put it in the definition, and I want this property, like this nonlinear martingale property, to be satisfied not only for the deterministic times, but also for all the stopping times, such that sigma is less than or equal to, right? And so that definition, at least in the right continuous case, in the case where y is right continuous with left limits and adapted, it appeared already in the works by Peng, right? Okay, so once I have this notion, so I can define also by analogy the notion of a nonlinear FQ supermartingale, the notion of a nonlinear FQ submartingale. And once I have that, I can define the notion of F martingale, what we call here F martingale measures. So let us come back to the parallel with the linear case. So in the linear case, I had the family of linear operators, which were the usual linear expectations. Then they entered somehow in the definition of a martingale, the usual notion. And then the notion of a martingale, I used it to define the notion of a martingale probability measure. That is a measure under which all the wealth processes become martingales. So I will do something analogous here, right? I have now the nonlinear operators, the family of nonlinear operators. With respect to that family, I defined the notion of a nonlinear martingale. And now I will say that an equivalent probability measure is a Neff martingale measure. If what? Well, if all the wealth processes, whatever the initial capital X and whatever the trading strategy phi, those wealth processes become nonlinear FQ martingales under Q, right? So Q is called a Neff martingale probability measure if all the wealth processes, whatever the initial capital, whatever the strategy, become nonlinear FQ martingales in the sense of FQ martingale that I just defined just before. Okay, and now I have those, once I have defined those objects, now at least, at least those formulas make some sense, right? At least we understand what is written on the right-hand side of the formula. So I wish now to come back to the, right, so we understand, let us for instance read this one. So I have those auxiliary market models indexed by Q. The set of all auxiliary, there are as many auxiliary market models as there are F martingale measures. So that was this set curly Q. And then in each auxiliary market model Q, I have my nonlinear pricing rule, which was this one with the very heavy notation in terms of indices. So I price my object, right, in my nonlinear but complete auxiliary market model Q, because I rendered it complete artificially by allowing myself to hedge against the both sources of risk. So I price my option here in the nonlinear auxiliary, nonlinear but complete auxiliary market model Q, and then I take the supremum over all the auxiliary market models. And here, from the point of view of the buyer, I do something similar, and then I price my option in auxiliary market model Q, but now from the point of view of the buyer, which gives me this. And then I take the infimo overall the auxiliary market model. Okay, now I want to come back here to do this remark. In fact, so what we can see is that, and which was maybe not so very intuitive from the very beginning, is that the set of auxiliary market models, in fact, it doesn't depend on F, it doesn't depend on the driver. And I have an explanation of that a posteriori. So if we come back to the models that we consider, right, we consider models which have two layers. We have first the layer in which we have defined the underlying assets, right? And that is what determines the set Q, the set of auxiliary market models. And then I have somehow defined the trading rules, the different constraints, trading constraints, which refer, so which have a consequence only in the wealth processes, right? Only in the dynamics of the wealth processes. And so from there, the non-linearity of the driver comes. So here we have considered models somehow in two layers. First layer, somehow the underlying filtration and the exogenous modeling of the underlying assets. That is what determines the Q, right? The set of auxiliary market models, if you wish, the curly Q. And then the other layer where the wealth processes are formed, where I had the non-linearity appearing in the nonlinear driver A. And that is why, because I have considered only models like that, as a matter of fact, the Q does not depend on A. Mm-hmm. And there is one-to-one, and that now with this explanation, it's not surprising that there is one-to-one correspondence between this set Q and the set curly R, right, which was the usual set of Martingale probability measure, right? So I can pass from the one, yeah, all right. So I can explain more here later on if that is somehow interesting and useful. And now I'm not so very sure how I'm faring with time. I think that I'm almost finished, right? So yeah, sorry for that. I explained maybe too much in detail somehow the economic intuition. So we cannot, but now because that's a stochastic and statistics seminar, and there are many previous talks on stochastic, so we can very quickly in 1 minute understand the proofs. So okay, so the proof passes, as a matter of fact, through the study of that. So I make my problem, of course, dynamic. Up to now, I focused on the problem from time zero perspective, but then, of course, I will focus more generally on the problem from time S perspective, right? Where is S here? Yep, from time S perspective, where now S appears here in the set of stopping times, and here that's the time of evaluation. And so I will study this stochastic control problem, which is nonlinear because I have a nonlinear operator, and mixed because I have here stopping and control, right? The probability, the equivalent probability measures, you can see them as controls because that controls when we consider the density processes. And so I study this nonlinear, this mixed nonlinear control stopping problem by using some earlier results that we had established on the nonlinear optimal stopping problem alone, right? And then, so I pass through those steps. So those are the 4 main steps of the proof. And then I obtain my pricing hedging duality. So what is interesting is that I have as an intermediate result, which I use in the proof, this nonlinear optional decomposition, which somehow is the analog in our framework of earlier results from the linear case that those who are familiar with financial mathematics are very familiar with. And also in the nonlinear case, more recent results by those authors in the case of continuous processes, and our result in the case where we have that default jump at the default time. All right, so I will stop here. So thanks very much for your attention. And I think I even used my time for questions in the talk itself.
Oh, that's fine. Miryana, thank you very much for your talk. Very nice talk. Yeah, I understood that unfortunately we didn't have time to cover a little bit in depth your proofs, but probably next time. But okay, now we have some time for questions. So just please ask your questions, if any.
I'm not sure that there are questions yet.
Yeah. I was interested, early on, one of the conditions you had was that the default intensity should be bounded. And I guess if you have more complicated models with contagion, that this may no longer be the case. Is there any hope for removing the condition?
So that's a very good question. I think that where we needed it, this condition is in one of the to ensure integrability, right, and to ensure integrability in one change of measure. So I have to, as a matter of fact, I have to check again whether this can be removed, right? So I don't have the exact place in mind at this moment. So I'm almost sure that it is that it is for that, right, for that purpose where it was used. But I have to have a look again, right, to be able to tell you.
Thanks.
I have a question. Everything is based on Brownian motion, Miryana. There's been a lot of work done on Levy process models, for example, or jump diffusion models. Can you say anything about those?
All right, of course. Yeah, okay, so that's a very good question. Somehow, how much beyond that I can generalize that. And indeed, so of course I have to redo the steps, right? But what I can say, for instance, here, right, when we had this modeling of the underlying somehow, as I explained, those two layers, and so that refers to the first layer, somehow your question, when I model the filtration and exogenously the underlying assets. And so here, what was very important when I started now building my auxiliary market models, right? Let me come back to that. So when did I start building them? So I started building them here, right? And of course, if I want to follow that same methodology, if you want to, all those same steps, somehow I have to be able to say the same type of things in the framework, more general framework that you are mentioning. And so, of course, so the first thing that is very important is that I have the predictable representation property, right? So if I have the predictable representation property, right, with respect, that is, if for martingales in the framework that you are giving me, that is when I will have here W, but also some other sources of risk. If I have the predictable representation property, then yes, I can. So I will have that. So yeah. So I will have this type of result, and then I will be able, right, provided that I have a sufficient integrability, I will be able to apply Girsanov's theorem, and I will be able to continue here. And indeed, there are results on BSDs with Levy processes for a long time ago. So if I will be able to follow somehow the same ideas, the same route, right? I will have that those auxiliary market models, right? I will allow to be able to hedge from the other sources of risk, right? And I will be able to somehow say that even using results, earlier results which exist, that this BSD has a unique solution, and then I will be able to continue, right? Then I will be I will be able to define this operator because my BSD will have one unique solution. So I will have this nonlinear operator. I will be able to impose a condition which will allow me to make the operator monotone. And if I'm able to do that, then I can define my nonlinear martingales. And so I will be able to pass also to this stage, right? This definition, this stage. And then, of course, I have to work, right? So let me come here. So this problem, right? This problem, when we considered it at the very beginning, we considered it in the case, so the smaller problem, right? Where I have just the nonlinear optimal stopping. We considered it in the case of a filtration which was generated by the Brownian motion and the Poisson random measure, right? And we also generalized later on the case where it is generated by the filtration, the underlying filtration, is that of a Brownian motion, Poisson random measure. But I mean, when the filtration is, so how should I say, is bigger than this one, right? Is bigger than this one. I have the Brownian motion, the Poisson random measure, and some orthogonal component. So here I know the results already, right, for this part, right? And then this aggregation step that comes from, as a matter of fact, uses arguments, very general arguments from the general theory of stochastic processes. Then that's very general. So that somehow is true for any filtration which is right continuous and complete. So it won't play any role. And then, so it will be true, I will be able to pass this step. And so this minimality characterization, I will be able to have it because it says, what is this? We didn't see in the talk, but it says that the value of this stochastic control problem is a nonlinear supermartingale which dominates the payoff process. And moreover, it is the smallest, so it's some sort of Snell type characterization. So this I will be able to say because that is, the definitions are somehow made in such a way that I be able to say that, right? The definition of a nonlinear supermartingale. So I will be able to do that. And then I will be, have to show this nonlinear optional decomposition, right? I will have to do some work because of course that depends, right? If we look at the result, of course, that depends here in this part, in the martingale part, on the martingales that I have, but I will be able to show it. Yeah. So I think yes. The answer is yes. And then the final step is just a combination. The final step is just a combination of everything, right? So yeah.
Yes, thank you. I think you got it covered pretty well.
Okay, so maybe time if there is a quick question. Okay, if not, let us thank Miryana again for her very nice talk and explanations. And I just would like to remind that the next seminar will be in 2 weeks, if Kostya doesn't have something else.
Oh, thank you very much. Thank you for your kind invitation and for participating and listening. Thanks very much.
Thank you.
Bye.